Thank you so much for joining us today here on Business Today.
Thank you, Selma. Thanks for having me, and thank you for pronouncing my surname very well.
Always a pleasure.
Okay.
I mean, as we heard earlier on, of course, the rand has strengthened sharply. We're talking about nearly 20 rand down to 16, of course, against the US dollar. What would you attribute this rebound to?
We have actually seen a 15.9 drop in the same figures, which is unprecedented. We have not seen anything like that before, especially within the past few years. It has gone all the way, I think, around 21, 22, and then it has been a very much enormous effect on imported products, consumer goods, and I'm sure we'll unpack more of it.
Yeah.
But you asked me a very direct question, what may have attributed to that? I would say it is a lot of global factors, although the outcomes may be stochastic a little bit. Our predictability, where we're close to predict this, but I think we can attribute it to stronger political stability, stronger financial resilience, and also how we have managed our interest rates within the economies, and also the great growth, the organic growth within the economy and performance has always been moderate comparing to our trading partner, which is the US.
Yeah. Just in addition to that, of course, you spoke about the political aspect and the financial resilience, perhaps the global factors that you highlighted, perhaps the expectations of the US interest rates and perhaps the geopolitical dynamics versus the development, the domestic developments within South Africa itself.
Well, I can maybe start there with an historic anecdote.
Yeah.
In 1985, they signed what they call the Plaza Accord by the G5 countries, and it had around 3 or 4 objectives, but the key ones are to ensure that they can maintain or control the devaluation of the US dollars. Secondly, it was to avoid or close the gap between the trade deficit the US had, and lastly, also to ensure that the US dollar economy could, they could eliminate trade measures that are more restrictive. What have we seen within the past 1 year is that most of that protective mechanisms has been lifted off by the US. And I think they have reversed the effects of the Plaza Accord. When they devalued the US currency, it was to make sure that products could have been more affordable to import. And because the US economy is bigger, they could buy more imports from other countries like Germany, Japan. And currently, they have not really paid much attention to keeping the US dollar a little bit flaccid to make sure that the US consumers can have a breathing space. Secondly, they've imposed more restrictions, and this was one of the avoidance that they did not want to have a lot of restrictions. However, they have defragmented multilateral type of agreements, and then also plurilateral discussions or policies that are in place, and they have chosen a more nationalistic, defensive, and unilateral approach to their policy and tariff measures. And lastly, the deficit has even grown deeper and higher, especially compared to countries like China, where they are facing enormous amounts of trade deficits.
We'll explore that point a little bit in this conversation, but just to talk about how, of course, there's some renewed optimism that this could, we could see some gains in 2026 for the rest of the year. But of course, do you agree with this analyst, of course, and also, but what could also derail this momentum?
The momentum is quite good, but I will flag it probably from a regional sense. Just take back on the question you asked previously. South Africa is a huge gold exporter. I think more than 140 billion just on gold exports, 180 billion on platinum. Gold moves within the domain of being a monetary power itself. It is a de facto currency because of the pure nature it operates on, the effect it has on monetary policy, and it doesn't have a divergent output like other products, which can be exported in different ways. But gold has proven itself to have a more stable outcome. With that, it gives us a more safety net as a regional bloc, an umbrella approach, I may call it. And the fact that South Africa really is having a currency or a financial regime that is always observing its fall and drop in the interest rates. So they are a monetary policy that is closely aligned with interest rates, and they make sure that they keep control of this. And I believe that that really gives us a safety net, and I believe it can continue.
And every time somebody mentions monetary policy, we talk, automatically the peg to beg, comes to mind, and we are pegged with the rand, of course. But in practical terms, what does the stronger rand automatically mean for Namibia?
It means that our imports will become cheaper, which means we can import a lot. That depends on the demand for these imports as well. I hope it grows. On the contrary, it means that a production cost of operating businesses in Namibia, especially for foreign businesses, can become very high because they have to put up more money or bolster more cash just to maintain the businesses, the salaries, and also other input materials or intermediary products. It can be good for Namibian exports, but it also depends on the buying power of these exports. We have a very good aligned export. If you look at the contrast of our exports, we are 33 billion worth of diamonds, especially looking at the 2024 figures.
Yeah.
It was around 26 billion for the mineral sector, for the ores, and around 14 billion around for the fishing sector. What can that mean? Yes, our products are under pressure to be sold cheaper, which means that they may not afford it if we export them. They may not afford it, which means we have to lower the values on them. I think the sectors like uranium and those will become stronger, actually because their demand is always going up. But in the diamond sector, there's a global effect, which means in terms of consumer preferences, we may not really just change the dynamics of the industry just because we have a lower, weaker, stronger currency locally. Which means in some sectors it will be good, in others it may not be good.
Just in addition to that, of course, because this always reignite debates around the currency bag. And of course, in terms like this, does this perhaps in any way constrain Namibia's policy flexibility, or does it actually provide useful stability? Of course, considering the sectors that you highlighted.
I can bring up the import-export ratio because it also plays a big role in terms of setting our GDP. If we, in the beginning I mentioned that a more random outcome is not good, especially where we are now. It should have been predicted that this may happen, which means the control factor lies within our means to ensure that these outcomes do not just happen in a stochastic manner. But then if we take charge of controlling where we are really putting up bigger focus on exports and at what value and what level, it can be distorted by exchange rate fluctuations without causing harm on the local sector.
How can Namibia navigate through that, though?
I think it is by employing more strategies, applying more policy instruments, especially also in the monetary sector. It is needed. One of them I can simply highlight is ensuring that we have a stronger gold reserve. It is very important. When we also speak about agricultural products, yes, we expect that agricultural products will become cheaper, because obviously we've always spoken about having a safety net of key or fast-moving goods and consumables from the domestic economy. But if you look at the currency effect, I'll point out fuel, for example. Fuel is a broad income. It is applied everywhere, and we import close to 26 billion worth of fuel every year. Now, there's an offset. NAMCOR will collect less revenue, which means they may come back and put pressure on us that the prices will remain high. But if the policies are good enough, we can tell NAMCOR, for example, or the fuel wholesale sector to reduce it so that we can expand on our exports. And I think that will be a positive direction. So if policy speaks to these instruments, gold, for example, can be a good offset for debt relief, meaning that when the dollar appreciates, we can actually offset more gold to ensure that we sustain a local stronger financial monetary policy. So policy direction is important indeed.
But at what, let's say, given that these instruments are implemented as well, would you say that there can be an expectation or realistic expectation for inflation to ease?
Very good question. We can speak about deflation, meaning that inflation outgrows the level at which the economy grows, and it means that our products may not even have value at all because they may be just hyped up or have a balloon structure in terms of monetary terms. We have to control it. We have to manage it. But the good thing is we can expect lower interest rates. We can expect it to be simmer a little bit down, cutting down, or let me say sliced on the edges. And yet with excessive local or domestic spending, we have to ensure that people really spend in the right ways. Long-term investments, not just quick buys, high exponential spending, but increased saving mechanisms. Probably looking at the deposit and savings ratio of the country.
Absolutely. Just to shift the focus a little bit in terms of some perhaps implications for government when it comes to finances, especially in terms of foreign debt servicing, Rodney, and of course just customs revenue and broader fiscal planning.
Revenue may be problematic. as mentioned earlier, it depends on the demand and the demand and supply of our domestic products. If the demand doesn't grow, then it means the revenue will not grow amidst our lower or more, subtle exchange vis-a-vis the dollar. However, if we take a decisive action in ensuring that we are also strengthening our gains in terms of our key exports, our key raw minerals, more value addition, that will ensure that those sectors actually grow. Debt, I will maybe point out the treasury bills. We may focus on short-term debt, which would be a good move, but not long-term, because in the long term, we always feel the punch when there's a reverse cycle from the dollar. But if government can use a short-term debt position, for example, pump it more into what we did previously or recently into the youth growing factor, highlighting the MSME and the informal sector, those sectors really need a focus. And I would also maybe call in the development financial institutions, if they can capitalize on this situation right now and see how they can, bring catalyst in growth.
Just in addition, I don't want you to repeat yourself, of course, just as we conclude this conversation, Rodney, just from the businesses and policymaker point of view, and perhaps how we can take advantage of this, currency strength rather than, just
yes, I'll
not
bring
taking
it,
advantage of it. Yeah.
Sure, Selma. I'll bring it to the table. I think we should ease a little bit within a certain time frame about, investor confidence will be more, I doubt it will be about government, putting it into government projects because of the low interest rates. But I think they want to look at a stronger currency regime in terms of investing in the domestic businesses, because it is a stable place, and South Africa will also provide a stable position. And I think those intermediaries, the financial intermediaries, should really think of, for example, some of our key institutions, institutional investors, they should think about diverting those funds back, because the dollar that they were expecting will not be the same. Now it has significantly, the picture has changed. They will not get it back. But if they put it in the home ground here in Namibia, they will get a better penny. So I think domestic muscle in terms of finance should become stronger this year. Especially, one thing about the quarter we are in, the fourth quarter, it is a reflection of the third and the fourth quarter spending, your December hype, the holiday hype, the high imports. As the year goes, let's come together on the table, and I think sooner than later, and find out mechanisms to use this opportunity to the best advantage.
I just want to take you back to a point you highlighted earlier, and I think we've had this conversation before in terms of trade. We have more imports than exports, of course, but what can change the status quo? Where are we really struggling?
We have just a historic reflection. We had imports were around 100 billion, 120 billion. It was around those meager amounts. But now we're looking at 160 billion. It means it's almost coming close to 1-to-1 with the GDP. Your imports at 160 billion, your real GDP at around 170 billion. That tells you that we import at an enormous rate. It's faster. Is that maybe it's a sign of a dynamic economy, because we have different facets of growth, very highly competitive economic segments in different spaces. And it always demonstrates that also the entrepreneurial drive of the country is very high, because they want to find goods to compensate for what we don't produce locally. However, all that can be summed up in our approach towards value addition. Value addition in the mining segment, how we have got different stages of beneficiation for every commodity and product, meaning that everything that grows or goes into the Namibian economy, you make sure that you touch or circulate it enough within the economy.
Equally with the agricultural sector as well.
Including the agricultural sector, circulate it enough. If we export, for example, not that I want to really petrify a sector, but if we, for example, export our beef, around for our little heifers, and then import them back as mature beef already, then it means that we have not really touched on the value chain. And those are type of the more robust topics we need to have around pushing a more stronger dependence and reliance on our domestic economy.
Absolutely. Rodney, thank you so much for joining us this evening. So it's a pleasure talking to you.
It's a Monday, and thank you very much, Selma.